I think in most cases, these people don't actually know the first thing about investing. And I really mean that like literally, like they don't know anything, even though they have like a good track record that coincidentally started in May 2022. If a guy's track record started then, he's told you the real story. He had a horrific drawdown into that. And I get the very strong feeling from these people that they don't believe at all in what they're doing or saying. They just see it as like a cash grab.
This episode of Other People's Money is brought to you by VanEck Semiconductor ETF SMH. As you may know, SMH is the largest semiconductor ETF by AUM with over 25 billion in assets. What you might not know is that SMH has historically outperformed its largest competitor, SOXX. In addition to SMH, VanEck has launched SMHX, a first-to-market fabless semiconductor ETF that has been intelligently designed to capture low capex, high-margin chip designers setting the next stage of AI. More on both later in the show. Hello, everyone. Welcome to another edition of Other People's Money. I am joined today by David Orr, CIO and founder of Militia Capital, a long-short equity hedge fund that is increasingly transforming into a multi-manager hedge fund. David, thank you so much for being here today.
Yeah, thanks for having me.
All right. So, as I said, Militia Capital is transforming. Why don't we start with what is Militia Capital today and what was the path like to getting here?
Yeah, so today, it's just me and two portfolio managers. We have 160 million assets under management, and the fund launched in 2021 with only 3 million. So we've been growing pretty fast, but actually, we're not growing via raising money too much. So we've sort of made a lot of profit since inception, and that's sort of how we'll keep growing from here.
Do you have a hard cap where you will actually start to return capital out to investors? How long do you think you can compound capital internally?
It just depends on, like, how many other portfolio managers I can find, for example. So if we can find another, we're hoping to get to 7 total, including me. In that instance, maybe this will go to $1 billion. Um, and otherwise, probably start returning money a lot sooner.
What did it look like before you brought on other portfolio managers? When it was just you, I know you always wanted to bring in portfolio managers, and some of that comes from your poker background and the idea that players stake other players to go out there and sort of limit the volatility because poker losses do happen. There is luck involved, as there is in markets. So, what did it look like at the beginning before you had these portfolio managers, and why did you always want to do this?
I sort of knew that, raising money for one guy and selling a story on one guy is already kind of hard. So that's why I launched with only 3 million bucks. So I knew that if I could sort of prove my edge over a few years, then investors would be a lot more patient and open-minded to, okay, well, Dave's trying to risk a small percent of the capital on this other portfolio manager. He thinks he has a good read. So fine, we'll see how it goes. And then, after that starts working, then investors get comfortable with it. They actually start wanting to add money. And then, yeah, you bring on another portfolio manager and he starts doing really well. And then people start getting kind of excited.
So when you were bringing the portfolio managers on early on, were you more backing them from your own, like, profit allocation?
Yeah. So the number is since inception, I'm only even have $10 million of net deposits in my own partition today. And my account NAV is 90 million. So that means, the other 60, 70 million, it basically went to the other portfolio managers, and that mostly came from me. So we raised a little extra for them.
And the capital that you have been able to raise, how have you gone about finding new investors or them finding you?
Just word of mouth, really. I mean, my initial investors sort of just felt like were following my comments on companies. So the best example is the first guy. He was a long short bond portfolio manager. He had his own fund, and he just saw that I kept talking about the same companies that he was following, and he realized that the equity of all these companies, he knew it was all worthless because he's shorting the bond, like the more junior bond, and he knew that was worthless. So he's like, well, wait a minute, this guy's shorting all these companies I follow anyway. So that was actually one of the first 10 people to ever follow me on Twitter was that guy. And then he's now a big LP, and his business partner, he's invested with me too.
How did you get into finance Twitter? And can we talk a little bit about your social media presence and why you feel comfortable talking on Twitter when so many hedge fund managers are either anonymous or stay off social media entirely?
Yeah, I don't really care what other people think about me, so at all. I've sort of been, especially, back in 2018, I grew up on the West Coast. It was sort of inappropriate to say a lot of views. Even back then, I'd sort of say it in my old sort of hometown circle and things, and I just didn't really care. So that's why, I'm fine saying whatever I think, and people don't like me, they can go ahead and not follow me. I don't care at all.
Yeah, but I'm talking more about the, compliance side. Like, if you go hire a fancy white shoe law firm, they're gonna tell you not to go on Twitter. If you push them a little bit, they'll say, "Well, I guess you can, but we would still recommend not doing it." So, how did you, as a relative industry outsider, come in and say, "No, I think that, people are generally too cautious about this
I
regulatory
just
thing."
I read a lot of the laws, and I don't really know where their super conservative interpretations come from. In one instance, a compliance person, sort of was telling me I can't do certain things, and I was like, "Well, show me where it says this." And they actually linked me a thing, and it says specifically I can do what I'm doing. So, and I told him that. I'm like, "Well, it says it here, and you linked it." And he just didn't reply to me. So that was the end of that conversation. And this would happen over and over again. And then besides that, I sort of contrasted what the lawyers were saying I would get in trouble for versus the behavior I'm seeing, really bad, actual bad behavior all over Twitter from real bad actors, and they don't ever get in trouble. So, I can't reconcile the two things.
The sort of "I don't have to outrun the bear, I just have to outrun you" aspect of it. But then there's the enforcement priorities aspect, which is at any given time, the SEC and other regulators have specific things that they're really targeting, and they're going after, what are the really bad, egregious things that are happening right now. And, there's an argument to be made that, you know, a portfolio manager accurately depicting their returns and their strategy in a, fair and balanced way. It's not necessarily the highest and most important use of their time at any given moment.
Yeah. Another mistake that other fund managers do is they rely on the 506B exemption. Most hedge fund managers are using that one. And they actually created the 506C like kind of recently. I think it was in the, I forgot the exact year, like 2010 or so.
The
And
Jobs
it,
Act 12.
yeah, and like that one actually gives you a ton of leeway. And so that's the one I'm using today. I was more careful on 506B, but as long as you're checking that your LPs are accredited when they're joining, then there's not like that exemption is so broad and powerful. I think the reason lawyers don't suggest it is because it would put them out of a job. I think it's that simple. Yeah, because then, you don't even have to, like, have them review every word you write on your website anymore, for example. As long as you do that one key point of, "Is this investor accredited?" And then the threshold on that's not as hard as it seems 'cause, there's, like they haven't defined the exact dollar amount, but if someone invests $250,000 in a fund, the fund manager is pretty safe to say to just assume that that person is accredited because the dollar amount is so high. They don't actually have to do like the full dollar amount of the accredit because, that's not the case either.
They actually did define that this year. In
Oh,
the spring of this year, they explicitly said that for, individuals, 250K is that level, that if somebody can
right.
can stroke a $250,000 check, you can assume they're accredited. It's different for, like,
I read this
trusts and
before and I could see some back and forths, and that was the number I thought it was. So that's pretty cool to hear.
yeah, I mean, it was that back and forth that was going on, and they officially came out and commented in the spring of this year, so
Great.
it did really open the door quite a bit. But even still, I mean, you were just getting a CPA letter or a bank statement. These are not particularly hard things to do to have to verify somebody's
Yeah.
accrediting. But
Mhm.
the other side is when you start to do things more in public, the argument could be that you have a greater compliance burden. So why do you think that if you are the 506C, you don't necessarily have to have everything reviewed?
Oh, yeah, because you're actually free to market. You're allowed to market on your website. as long as you have, the correct, like performance, you're showing gross and net returns and everything. You can't super cherry pick returns, which some people are right now today, and they're not getting in trouble. You have these fund managers who talk about their returns, and then mysteriously 2022 is missing. You see that all the time, for example. You can't do that, and I wouldn't try to mislead people that way. But yeah, you're allowed to post your returns.
Yeah, and a lot of people do talk about that. I mean, and podcast hosts and those of us in the media definitely contribute to that because you hear about somebody who had a great year and you bring them on, and it's like, so and so in 2024 did XYZ percent
Yeah.
net. And then that's all we hear about because it's hard sometimes to get
hmm
your hands on marketing
and
material.
also, I'd point out too that just from like a practicality standpoint, that's not even illegal. That type of cherry picking, if you bring it up and the guest responds and that interview goes live, then guess what? The guy doing the interview, he didn't break any laws because he, of course, has the freedom of speech to respond to a question in a live interview. There's no, so I think this whole, yeah, sort of this whole regulatory structure is kind of silly anyway. It doesn't even work.
What is the fee structure like?
Right now, we're doing a 0.5% management fee. And then we before up until next year, we have a S&P 500 hurdle. That's gonna change in 2026 to the risk-free rate, because the portfolio volatility has gotten so low. Um, so yeah, it's been a really favorable fee structure for LPs too.
Why has the portfolio volatility gotten so low, and why do you think that justifies changing the hurdle rate?
Yeah, so the multi-manager, and then my own I've sort of, like, learned over the years to lower my own risk on top of that. So today, we have, like, over 1,000 positions, so it's almost like we're long and short broad ETFs, at this point, versus in my earlier years, when we first launched, I had almost doubled the S&P 500 volatility. Today, it's a bit lower than the S&P 500. Um, so yeah, that's the main reason, and then the reason this is important is because if you have a lot of volatility in the portfolio, the hedge fund manager automatically has like a way higher implied fee because in the downside case, they're not getting hit their own personal money, but in the upside case, which is way more likely, they make a fortune. So, and then now we've sort of made the downside case for LPs way smaller. Um, but that actually also, now that we have three portfolio managers, we're sort of eating each other's risk, right? Because if one guy performs so badly that the firm doesn't really earn a performance fee that year, we can't pay the other two guys, even though they did well, which is another way of quantifying it.
A lot of the big multi-managers, they'll take that performance that should be paid out to the portfolio manager as a fund expense. Why did
hmm
you decide not to do that?
Just too small. You can't, just for practical reasons, you can't, like, let's say that one guy super kills it and you owe him $10 million, and then the other two guys do really poorly, then there's actually not money to pay him. Like, sorry, it can't happen.
So I guess the big multi-managers say that we need to do this to keep the talent around. So why are these portfolio managers sort of joining the militia team, and how do you incentivize them to stay part of this when obviously you seem highly confident in their skill and their ability to do this on their own?
The main thing is, we're doing a partnership model long term, so they're gonna get 90% of the performance fee economics, like their fair share of it, which is way higher than the multi-manager. And then the multi-manager has all sorts of other hidden costs. So my understanding is that most of them don't actually give the person capital. So you're paying the financing costs and all sorts of big other overhead costs, right? So even if you make, say, a pretty good win, they're like, oh, because of our fancy accounting, you don't actually get paid anything. And then another issue with them is they have these super tight stop losses. Um, that they'll cut your AUM in half if you lose 3%, which to me is insane. And so like, I would never personally want to work at a shop like that. I think I would feel very uncomfortable. And the other portfolio managers with me see it the same way too. I actually think the pod shop model is going to get they've gotten so big, they're going to start impacting the market because of those super tight stop losses, and it's going to create inefficiencies that work against the PMs as well. So, smart PMs realize all of this.
Well, we already see the commentary from people saying, "Oh, look, I heard a pod is blowing up," when you see, like, huge dislocations in a sector. How much of that do you think is the impact actually kind of already being here versus, armchair quarterbacks on Twitter?
I think it's partially because I've been involved in some of those blowout moments, and I'll actually sort of jump in and provide some liquidity there. Um, But yeah, I don't think it's gotten super bad yet, but definitely sector to sector, weird pair trades, they do blow out and the people do get shut down and that's it. They show them the door.
It's interesting that you have this opinion of the multi-managers because you talk a lot about your investment philosophy on Twitter, and you seem to have a very strong belief that you have to take a lot of bets. Something that the multi-managers are obviously doing. They're looking a lot at their factor exposure. Something that you criticize. Many more concentrated investors for not thinking about. So it seems like you do have a lot in common with the way they invest philosophically. Where is that line, and what are the things that make up the tenets of your investment philosophy?
Yeah, the big part is I don't think that their stop losses for what I'm doing it doesn't make sense. For what they're doing it makes sense because they're backing so many individual people. They actually can't even track or understand the risks of the portfolio managers. So let's say that they have the 3-4% stop loss, or not, it's not even a stop loss, it's where they'll cut your AUM in half, and then let's say when you're blowing out, it pushes the market against you. So they actually lose more. But let's say they lose double that amount. Let's say it's at 8 or 9% and it's a small part of the pod shop, that's a fine risk control for them. Whereas in my case, if I'm allowing a PM to have more like a 10, 12, 15% drawdown, and then it's double what I expected, you know, that's a lot more dangerous. So I actually have to understand the risk of what they're doing. And I can because it's not like a zillion people, it's two guys.
Semiconductors have driven decades of innovation, resulting in massive efficiency gains in the global economy and powering tech giants such as Google and Amazon. SMH by VanEck is a focused ETF that captures the whole semiconductor value chain, from top-tier designers like NVIDIA and Broadcom to foundries such as TSMC and through to equipment makers and software developers. Its market cap weighted, concentrated approach has helped SMH outperform historically its closest peer. Go to vaneck.com/SMHmax to learn more. Building on the design and success of SMH, VanEck saw an opportunity to launch a fabless semiconductor ETF, SMHX. It gives investors targeted access to the high-margin, capital-light segment of the semiconductor market. The fund focuses on chip designers that outsource manufacturing and are driving AI optimization and applications at the edge. Go to vaneck.com/SMHXmax to learn more. And now back to the interview. How much access do you have to your PMs, daily trading and activities? Are you getting notified of every move they make?
Yeah, every single partial trade, I get a notification and I can see it all. I can see their portfolios. I can see the fund level concentrations. I can see if they're, just selling tons of out of the money options or if they're betting huge on futures or what something crazy that they shouldn't be doing. I can see all that. So, um, and then I'm pretty good at risk management. So, since inception, the fund has had an 18% drawdown. That's even when I was a single manager. And, I was running my personal account before that, and the risk was also reasonable. Maybe January 2021 was not a good time, but besides that, it was quite good. And then I'm also aware of like how good these PMs are at managing their own risk that don't follow this super tight um, constraint. So, so far I haven't had to step in once for either of my two portfolio managers. So they're already managing the risk really well on their side, in my opinion. So I can understand that, oh, one of the guys, he likes to bet pretty big on things, but he also uses like a really tight stop loss every single time. But he wouldn't be allowed to even do that at a pod shop.
What about other types of collaboration? Obviously, you're paying close attention for risk management purposes, but what about working together on ideas, sharing ideas, making sure that you're not all along the same thing in size?
Yeah, that's actually the one downside of our model because they visited Osaka. That's where I live. Um, they came out and visited. One of them stayed out for 6 weeks, the other stayed out for 1 week. Um, and yeah, we were talking about it, like, yeah, we can't do this very often. We can't talk about stocks or trade ideas much, because we wanna stay uncorrelated, so it makes it kinda lonely that way. But so far it's been working.
I noticed in one of your letters you commented that your favorite thing when you talk about a name on Twitter is that you get no response, that a bunch of people agreeing with you or disagreeing with you is something that you don't like to see, and it usually means you'll step away from the name. Why
Mhm.
is it that you like, no consensus?
Yeah, it just shows you, like, why the, opportunity might exist, right? It's not like a battleground stock. Um, Also, another thing I do like is if I'm posting a short idea and it's not crowded, it's not behaving like a crazy story stock or something. In that instance, if like an army of bulls comes out and starts attacking you and there's not a single other bear and the thing's already trending down, I like that too. So it's not always dead silence I'm looking for, but silence is a very, very good sign.
And are you attracted to the short side? Like, what intellectually is your favorite thing to do?
I'm better at short selling, but I don't know if I like it more. I sort of like all of it. It sort of all fits together as this big puzzle. I like managing the business. I like finding good longs is always exciting. Um, yeah, I like longs you can hold for years. I don't like these sort of trading oriented longs too much. So, but when I find a long where I'm like, yeah, I think this I could see myself holding for 10 years and it's simple and there's no complex thesis. I like those a lot. That's always really satisfying.
Do you trade around those longs at all?
Not as much anymore. I used to, and then over time, I've come to realize that, beating the tax advantage of just staying long is really hard. I will do things like sell out of the money covered calls if it gets like a year-long one for January, for tax reasons. I've started doing that more, now that we're at pretty crazy valuations in the market, but for the most part, not too much of that even.
So would you say the portfolio turnover is mostly on the short side?
That's also a lot lower than it used to be. Nowadays, I just try to stay short except for, tax loss harvesting, which I do really routinely. So if a short's losing, I don't think about it too much. I'll just sort of quit and then put a on my calendar for 30 days to rejoin. And then, I can short more of something that's very similar anyway.
It's interesting that you seem to focus so much on taxes. If you hear, investor based outside of the US, you would assume that they're running a lot of offshore money. So are most of your investors US based, and how does that break down between onshore and offshore money?
Probably 70% of my money is US. Definitely a good portion is tax exempt. And, you know, I think that on one hand, they could say, well, it's kind of lame that he's making these tax efficiencies and that is eating into the edge a little bit. On the other hand, if you zoom out and you say, "Oh, okay, the guy's trying to, like, super do right by his investors," that's that's the more important part of it, right? And then the US investors love it, because they don't have any other funds that do it this well.
These US investors that are taxable, are they mostly high net worth? What type of investors have come to you? And I know that you're not taking on new investors right now, but I imagine as you've crossed over certain AUM levels, the track record has reached a length that people feel like it is representative. You started to get other, more serious interest from more institutional people. What has that journey been like?
Yeah, I mean, I got an offer to have $50,000,000, a year and a half ago, I forgot exactly, 2 years ago maybe, and I just told him, "No, I don't want that." Um, I don't wanna grow like that, I care more about the scorecard of it. We might like if we find more PMs especially, and then we want to upsize them because they're doing really well. In that instance, maybe we'll take another guy or two, but yeah, I just don't really like the idea of growing. I think that's another thing that kills the hedge fund edge. You see it over and over again. Even guys I respect like a lot, I think they're really, really skilled guys, but you know, you, you see them and they're getting up to like 700 million dollars and single manager. I don't think there's a big edge there for anybody.
Is that just because of the size of the companies you have to trade, and that those stocks are just priced more efficiently?
Yeah, it's your investable universe gets way smaller, and then the things that you are investing in, you're actually pushing the price against you. I can even feel it on my $90 million partition where, it's not too bad, of course, because that's not that much money, but, and there are spots and I'm like, should I just sort of push this thing up 2% against me to get into the position? And that's a lot, 2% there. And that'll really add up over the years.
I guess your portfolio managers that you're adding on presumably play in these smaller markets too. Are there just that many companies out there in the world that you don't think you're gonna have too much crossover? How are you just all gonna be long and short like the entire market?
I pick guys with different styles than me because, like I mentioned earlier, I don't like to get long the higher turnover long stocks. But one of our guys, he does know fundamentals and he focuses on it too, but he doesn't drink the Kool-Aid, and he's fine joining a story based on, if a story is rapidly improving. Even if the valuation is a little nutty, he'll get involved there on the long side, and I can't bring myself to do it, for example. The short book's a little harder, but even that, yeah, because he's from Spain, one of our portfolio managers, and he can do more European stocks. I don't really short European stocks. So that's like a whole new investable universe. I'm going to start getting more into the Japanese shorts also. I'm trying to work out a broker deal where I can get better rates on that. So that'll also lower our correlation.
What is the borrow like in Japanese stocks?
Japan has these weird rules. So um, they have the artificially low interest rate. So you don't get a short rebate, which is already a big headwind. But then they have this borrow desk where everyone has to sort of go through and pay this 1% floor plus some extra. So even on a super easy to borrow company, it's always like 1.2%. But if you can get on one of a few brokers, you can actually bypass that and get, the 0.2% borrow instead. And that, extra 1% a year carry matters a lot to me.
You mentioned you don't get the short rebate. I think a lot of retail investors in particular are used to paying a borrow to short stocks, whereas hedge fund managers, at least more recently, now that rates have come back up, have started to actually shorts have turned into something that can be positive carry. Now, if you're only shorting like the hard to borrow names, obviously you're gonna be paying for that. Uh, how has that changed since when you started in 21? Rates were not high.
Yeah, made shorting a bit easier. I mean, shorting in 2019 was much harder just from that reason alone. Most of my shorts have a positive carry on, which is pretty cool.
You mentioned earlier people that you respect, that they are getting larger. I generally, when I follow your commentary online, you talk a lot about the types of investing that you do not respect. So I'd
Mhm.
be interested to hear. Let's start there. What type of investing? We don't have to name names, or if you want to name names, go ahead, throw as many punches as you want. But what is the type of investing that you do not respect, and then we can go to the type that you do.
These like all-in investors, and it can be a single stock or it can be like the same single factor bet. Um, there are some guys who are just long, non-profitable junky companies. They have a big retail following. They were able to raise money pretty quickly in some cases just because they're talking about the right kind of exciting stocks. And I get the very strong feeling from these people that they don't believe at all in what they're doing or saying. They just see it as like a cash grab in most instances. In some cases, in the more single stock example, they did drink the Kool-Aid more. Uh, but I think in most cases, these people don't actually know the first thing about investing. And I really, really mean that like literally, like they don't know anything. Uh, Even though they have like a good track record that, coincidentally started in May 2022. So, that's a tell, guys. If the guy's track record started then, he's told you the real story. He had a horrific drawdown into that, and he's not telling you about that.
Doesn't the fund have to start then? I mean, how do you pick you're saying they just closed the fund and reopened a new one?
Well, in most cases, it's more like they're advertising like their strategy. And then it started basically because that's when speculative stocks bottomed in 2022, even though the like ARK dropped more into December and the market itself bottomed in October. The real bottom in the speculative junk was more like May. And so if someone has like this really high return from exactly that sort of very, very bottom, um, I mean, what are the odds that's when they actually began investing, right? I mean, it's just not the case. And so they're basically cherry picking what their real result is in a way. I mean, they're not outright lying. I guess it's probably legal, but the people investing with them don't know the whole story there. So I think anyone who's, going to invest with someone like that, you should always ask, "Oh, okay, well, how did you do from November 2021 until May of 2022?"
It's interesting because I know you yourself used to put your personal track record from before you had the fund in your letters. You felt it was representative of what you had done, and since you've registered, you got advice to take that out of your letters. So I
Mhm.
know that you wanted to show that because you felt, this is my track record. I want to be open with it, but I do think people sometimes who haven't been in this seat where they've had to like deal with the lawyers and actually writing it out, like what qualifies as the track record for a fund is not necessarily the track record for the man.
Mhm. Yeah, it's a good point. I still think that in most cases, people like have very strongly hinted or at some point shown what their results were in many other cases. Also, before you register, the SEC doesn't actually care like as much. Like they're not going to bother you. Um, I mean, in a lot of cases too, these guys are just marketing their fund openly on Twitter, no disclaimers, no, none of that. So they're already breaking other rules too, pretty blatantly. Even though I'm like big on not doing the compliance thing, at least I've started. Yeah, I'm actually building a website right now. So anytime I post my letters, they're going to go on the website, and there'll be the disclaimers, and there'll be the neta fees and all the sort of lawyer language there. Um, but yeah, I'll be able to post that, and that's great. But these guys are already breaking like another rule. So do I do I give them full credit there? Not really.
So you said these guys that you don't respect, they don't know the first thing about investing. I guess, what is investing to you? What do you think is important and where does the industry generally fall short?
On the long side, like a lot of self-described value investors or story stock people, they don't even know how to read the balance sheet, I think. Like the value stock investors, very often they will just completely ignore the debt and that they won't even know that the company is like one little mistake away from going bankrupt. I don't think they're aware of that. And it's weird because I'll see it happen with multiple companies that they're in, and they'll always be kind of surprised or they'll never have talked about this downside. And it'll be something as like simple as, oh, they had 2 bad quarters in a row. Now they're bankrupt. Um, so yeah, I think just focusing on the balance sheet, the capital structure, because you can have like a kind of reasonable operating business, right? If it's got, 50, 100 million bucks of operating income. But man, if it's sitting behind $2 billion of debt, or another example is, let's say a company is only moderate to small losses, but if they have a bunch of lease liabilities, those will also eat a company alive pretty quickly. And that, you're stuck in a lease, you can't quit that just the same way you can't quit debt. So the leases really get the value investors. Um, and then yeah, I think the story stock people, they don't even care about the earnings. They're just pure story. There's no fundamental aspect to it. It's like a vibe check. It's like they're good at reading the attitudes on Twitter, and they lean into the thing that they think is the right thing. I'll sort of be a contrarian here because this guy gets a lot of hate. This Jonah Lupton, I think his track record is probably real, and if so, I'd actually give kudos to that guy because if it is real, which I think it probably is, to be clear, uh, and he had like a 20% drawdown in 2022, and he's like this guy who's in these really speculative companies, right? So in that case, if the numbers are all accurate, that's like very impressive to me. I'm like, wow, this guy didn't drink the Kool-Aid, or he did properly hedge, or he didn't stay wrong, or he actually did something correct. But as far as I can see it, he's the only single guy who's actually done that, um, out of any of these sort of story stock people. The rest of them just sort of showed up in May of 2022 or early 23, and that's when they've sort of started collecting their big following. So there's a big difference there.
It's funny because there's the guy who's, like, claiming to be the Carvana guy, but I think, all of us think of, like, Cliff Sawson as the real Carvana guy. I mean, he wore the drawdown all the way through, didn't do the scummy thing, closed his fund, he stayed with it, and now we're back out on the other side, and, you know,
Yeah, I
what do
mean,
you think about that sort of person? Because he wore it all the way through.
I think if you look at all of his other picks, like I just look at his portfolio for short ideas. I've shorted like all of his other picks. You know, I ended up losing a small. I didn't because I was short big on Carvana on the way down, and then I added some, so I ended up losing some on back on the way up. And I didn't, I sort of said at $40 to people on Twitter, like, hey, you don't want to stay short the epicenter short squeeze thing. That's just not good. So that's sort of when I stopped being involved there. Um, but yeah, like how can it be that like all of his other picks pretty much are so bad? And then just this one that was like on the very verge of insolvency too, right? So when I look at the overall basket of things he's bet on, plus the valuation he was long Carvana in 2021, you know, overall, I think he doesn't actually know anything about fundamental investing.
So you said the value guys also get things wrong, and then you have the story stock guys. I love when they converge because I feel like value guys tend to believe that their value names could never be a story stock or that there's like hot momentum money behind the name. So you have these things that on backward looking, simple price multiples, they look cheap. And then they
Mhm.
start to move, and then the value guy goes, "Oh, the market is finally starting to realize what I have known all along is that there is this great value here when it has just become a story stock." Like, do you like that intersection? It's one of my favorite places.
Yeah, what is it? It's Dillard's, right? That's a perfect example where that was a total value stock. And then have you seen that chart where it's like beaten Nvidia or whatever for
Yeah, yeah.
years? And it's like Dillard's, really? What? So that's a funny one to me. But yeah, I think it's always amusing when it happens. Because you also it's amusing to me because I'm sure that the value guys never catch most of the upside. Like I'm guessing they're the ones selling to the story stock people after it's, who knows how much it ran up.
The housing sector was like that for a while. Now it's become a rates factor bet.
Yeah. I like that bet because it hedges shorts so well. Because shorts are so rate sensitive most of or a lot of the time. So, you're long home builders and yeah, they're gonna go down a lot if the rates go the wrong way, but then your short book will probably kill it too, so they really pair nicely.
So how do you think about factors? Are you thinking about it as rigorously as like a pod shop, or are there just a handful of factors that you really like to care about?
It's funny, we're having a discussion about that today, me and the portfolio managers. We're saying, "Well, should we do more of a strict quantitative factor overlay on what we do?" And I said, "No, I don't think so because the factor hedge itself, the instruments that these guys are using to bring their factors to exactly zero, I think those themselves are going to get crowded if they haven't already." And then, one of the guys like, yeah, I thought of the same thing. I think so too. So I don't think you want to be that neurotic about it. I think it's better to just sort of watch the factors, know what your beta is to various factors. Like something as volatile as ARC, for instance, you don't really want to go lower than negative zero point 0.2 beta to that. If you have a short term trade, try and with the stop loss, of course, higher or I guess more negative is fine. But, you need to be aware of what that is because if you get to like -1 beta to ARC, and I swear some short sellers are, and, you ride that wrong for long at all, you're gonna get totally killed.
So do you believe at all in market timing or taking sort of like big bets to say, okay, ARK is obviously deflating at this moment in time. Let's take on more exposure like that. Do you do that ever?
Yeah, I did that in February. I could feel that junk was peaking right there, and this was even before the tariff news hit, so the tariff portion of that was kind of a lucky follow-up. But even before that, just based on, what happens with the junk melt-ups, it's always the same thing. There's some epicenter ones. Once those start losing steam, the money starts flowing into a lot of other not a lot, but like a few other things that start going kind of crazy. Once those start losing steam, the breadth goes really wide. And these things can all be kind of correlated. Usually maybe the very first one is kind of weaker. It can be strong, but you don't pay attention to that one. But when you see the the overall basket of these things, the correlation just dies down before it's fallen yet, that's a good spot to try it because, the market has sort of showed you just under the surface what's happening. Oh, okay, they've spread to too much junk. They've no more dry powder. Then you want to attack them.
What is the environment that you see right now?
This isn't as a strong of a read for some. I can't even say why, but as February, but I definitely get that feeling today now. But if I'm wrong, I'm not going to stay wrong for very long. I'm going to just sort of suck it up and take the small loss. So, but yeah, I'm on the offense right now.
NVIDIA obviously been a huge part of this bull market. How much attention do you pay to these sort of big bellwether names and how they can set the tone?
I was actually short Nvidia in the beginning of 2023. And then after I understood how the technology worked, I turned into a bull. And in the middle of 2023, I said it could become the most valuable company in the world. So I actually rode that long to like 125 bucks or something. Forgot the exact number, but um, yeah, I thought that was like a really obvious bet. And I was on fundamentals. I just knew that the earnings of this thing were going to just go surprise way, way to the upside. And, even today, the valuation in terms of earnings is not that crazy, right? It's very questionable if their mode is sustainable long term, maybe, maybe not. But if so, it's a very reasonable earnings multiple today, which, it's kind of weird saying that about this $4 trillion company. But I guess, if it is actually the bottleneck to true artificial general intelligence, it makes sense.
I think that that's a really interesting name because you talk about it being cheap. It was the one of the most hated names by what you would call like the value guys. Um,
Mhm.
what do you think they missed, and why do you think value guys tend to miss these things that, in hindsight, turn out to be extremely cheap?
They just weren't focused on the qualitative aspects of the company, and that's what they do with almost all of their investments. That like one of them thinking right now, he likes like a restaurant mall, sorry, like a mall restaurant stock. So their restaurants are always right near a mall, and all the malls have become really.
DJs?
That's another one I've always considered as a short. I'm actually not short that one right now, but
Yeah.
I can't say which one
Yeah,
it
yeah.
is.
Okay.
But yeah, and then I'm just thinking like, man, has this guy like, I don't know, it's a perfect example because he's not looking at like the trend in the earnings or the margins, and he's not looking at the balance sheet. He just thinks all this thing's too cheap. And I don't, there's no qualitative element there to him. And that's the same leak he has on Nvidia. He's not willing to think, oh well, even just the abstract story of artificial general intelligence, that's a pretty insane thing if it's true. And then if you actually take the time to understand the technology, it might be true. It's not far-fetched at all. So
But I guess with my question around earnings was more, all right, you're out of the stock. It's not a long, it's not a short, but it's obviously hugely important for how the market overall is behaving because it controls, so much weight in the index, but also so much weight in the minds of investors as it relates to what has been driving this bull
oh
market.
yeah, so yeah,
As a fundamental, individual stock investor, how do you look at these companies that you're not on the battleground with that stock, but it's
I think
clearly an important stock?
yeah, that one's pretty straightforward because everyone thinks it's gonna beat and raise, right? And if the raise is like slightly more or less, nobody's really gonna care that much because these companies always can sort of sandbag or who knows why they're even saying the exact number, right? But if they beat and raise, the stock will probably go up some and the market won't care, right? But in the off chance that they do have some horrible miss, I mean, the market's just going to nuke. Yeah, it's going to be a catastrophe for the market. But I think most likely they're going to beat and raise. I've studied the technology enough. I don't see what can possibly disrupt them at least for another couple of years. So, yeah, that one's a little more straightforward. But you could say like maybe more of like the Fang stocks before like 2018, those would be pretty another similar one, right? And then back then, that was more interesting because there was more uncertainty, I think, if they would actually beat and raise the next quarter. Um, and then yeah, I think that's probably I think it's worth understanding those companies too, because they're going to impact the fundamentals of every other company or most other companies in the market, right? So even if you want to say, "Oh, I don't care about AI," you know, it's like, well, how does that actually impact your longs? Or if, you didn't want to focus on Amazon the whole way up, but you're long like retailers, you actually have to think about how Amazon sales growth is going to impact everything you own. Even if you think the Amazon, I think back in the day, the argument was the margins would never be positive. But so even back in the day, even if you thought that, it didn't matter because like they're still going to keep growing and they're going to keep sort of eating alive all these other retailers. So um, I think I think it is worth focusing on the giant companies for all sorts of reasons.
What about macro data and big economic announcements? Obviously, we didn't really get an actual like interest rate decision, but people interpreted Powell's speech as signaling that rate
Mhm.
cuts were coming in September, and that obviously caused the most rate sensitive stocks like housing stocks did phenomenally well. But then that sort of junky area that you like to pay attention to also did well. How do you manage days like that? And do you keep those days on your calendar?
That day was weird because you even if you knew beforehand what the news would be, it'd be really hard to predict how the market would even react. Because remember, the whole thing that even changed the rate odds a few weeks before the event were those big revisions,
Yep.
and the market like tanked really hard on those revisions because it sort of signals that there's something really wrong with the economy. And then when Powell follows through and sure enough goes with it was 80% chance of this happening, right? So it wasn't even really anything happened. It should have, in theory, been priced in, but it wasn't. Russell 2000 went up 4%. So that just seems like a casino to me. I don't think anyone can know why it's happening. Or I do like this account crowded market report that Jason Shapiro.
Oh yeah.
Um, so he's really smart, and he pointed out going into the event, hey, the Russell 2000 is crowded short. And I think that was probably the actual variable to focus on there. But even then, it doesn't seem like very solid to me. And I'm not really going to play that kind of macro data. The only big
Recent
macro bets I made were like inflation bets back before people thought there would be inflation because no one was talking about it. That was more interesting. But now everyone's already looking at the number.
What do you think about like macro track records as an equity investor?
I don't know enough. I'm kind of clueless there. I mean, Druck was a macro investor. He killed it. And I've seen some pretty damn good macro track records that's, I'm pretty sure are real. So even more, more modern ones. So I think there's probably a big edge in that game. I sort of would want to learn it someday, but um, for now I just do the really low hanging fruit, really, really obvious, like the inflation one. That was just too lopsided. So, but besides that, I don't have a clue.
Jason is interesting because he's using super tight stop losses, looking for these reversals in trend. So it's probably you know at, not very correlated or negatively correlated to the market. Is a strategy like that something that you would find interesting? Like, what is additive to you when you're looking for new portfolio managers?
So with portfolio managers, I want them to be uncorrelated to me and the other two portfolio managers. And so the main thing is if they're just a quirky thinker, like if they just think outside the box, that's a great sign because they're probably uncorrelated to anything at all. And then also, I'm looking for a couple specific styles. So I'm looking for a long short bond investor and a long short biotech investor. Those are the two I have on my radar the most. Because they wouldn't be correlated to what us three are doing.
What about those two strategies stuck out the most to you that you're actively searching for those right now?
Yeah, I just understand them because like they're both adjacent to what I'm already doing, right? Because the long short biotech is just the same idea. I could understand the risk that they're taking versus the underlying volatilities of the stock. With the bond guy, I'm familiar with most companies at this point, so I'd actually know what these bonds are in most cases. But it wouldn't be correlated to what I'm doing at all.
Have you traded corporate bonds before, and how different is that?
I've tried a few times not too seriously, and I've done really poorly like every single time. It's actually kind of shocking how bad I am at it. I've never really taken it seriously. I'll just sort of see one that seems kind of interesting and I'll try buying it um, in a really small bet. I guess what I'm missing there is the legal component, like the legal stack and understanding who gets paid first and how creditors can screw each other over and all that kind of stuff. So that's the layer that I'd want the long short bond guy to be doing well.
Have you done any experimenting with alpha capture or tracking portfolio managers with track records that you respect for idea generation?
No, I haven't bothered with that. I probably should get into that. Those websites are always I guess maybe I haven't actually tried that specific one, but I've tried a few and I never quite understood like if their idea scaled, for example, like they never broke it down in a way where I could understand the track record.
Well, I'm more saying, like, the track record is good. Like, you have the tear sheet or you have access to the letters so that you can see that the tear sheet is good. You're not gonna get a real-time look through into the portfolio, but in theory, you could look at 13Fs and you could say, "Okay, well, this guy, he's turning over his book so often that the 13F has, very little informational value. This other guy is positioned, 6, 9 months that actually, maybe he should be entering positions later."
Yeah, for 13Fs, I don't do it. There might be some edge there. I'm more like worried people would have like automated that out using bots even. Um, but like there are some people I think are good or like certain aspects of what they do are really good. I like Ian Bezic. Um, he's perfect for Latin America. He's given me more ideas than probably anybody. Um, and I don't even know what his track record is. I'm guessing it's good. Some of his picks aren't as great, but yeah, he picks some real home runs. So I definitely listen to what he says. Another guy would be like Nat Stewart. Another guy would be like Alluvial Capital, but Alluvial's less liquid, so that's doesn't work as well today.
Any other people that you, like to follow, whether they're on Twitter or just, broadly that you respect?
Just my whole follow list on Twitter is super curated. The latest maybe 10 or 15, they're newer. I don't know them as well, but I sort of have accumulated, I think, a group of people who are outstanding investors, like guys like Gator Capital, Raging Capital, um, like Blue Outlier, um, yeah, like Lurker Cap. Uh, yeah, and there's just so many good accounts on there. I mean, it's a tiny minority of Twitter, but if you find the right guys, they share really good ideas sometimes. Donut Short's another
What
great
a
one.
what about your favorite contras? You don't I mean, you don't have to name any names, but do you have contras? Do you use them? Are there people that you follow specifically to inverse
Not
what they're doing?
follow. I have like a list. Sometimes I don't actually use it anymore, but I used to have a list of contras. Nowadays, I just feel like if you're sifting through Twitter and over time the really bad people's ideas pop up. The thing is, I swear I'm like already short like the value trap guys. I'm like already short all of their picks. So it's sort of like not helping me to use them as a contra. It's like I've already agreed that their idea is not good, especially for the value trap people. The story stock people, that's not as interesting because really they all just move things as a group. It's very gambly. You can't even know which one is going to be the story that runs 1,000%. I don't really think that side helps for contras. There, you just need to understand like when they're exhausted, when they've sort of run out of steam collectively.
I wanna close with a few more questions about the business. You've crossed over the threshold that you have to register. It means more costs. It
Yeah.
means you have to do a lot more stuff that traditionally have been, the operational complaints that a lot of managers have about just how hard it is to run this business. What are the things that you've had to do now that you've reached this size for registration that, make it hard to run the hedge fund business?
Yeah, the worst part of it was just learning all the compliance law. Because Like if you ask ChatGPT anything about compliance, it'll give you a crazy strict, like even stricter than compliance professionals will say. I think it's just doing that to protect ChatGPT. And then if you talk to like a mercenary compliance person, you know, it's funny, like they won't even want to give you an answer. They'll want to like tell you to hire a consultant who will give you an answer for $40,000. And and then over time, you start like looking up what the actual rules are versus what these people are telling you. Um, and they're really just trying to protect their own job, and they're trying to make it as complex and pointless as possible so that I think they can charge more. Um, so I've really hated this side of it, but now that I've sort of gone through the grind of reading the compliance law, I'm not as worried as I was 6 months ago.
So if you were a manager who was approaching this threshold and you were going to have to start dealing more with some of these operational headaches, where would you send people to sort of arm them with the knowledge that you think you have now? And do you have advice for them? Would you say, push back on your compliance people, ask questions, make them show you the source material? What are the types of things you can do to make these people work for you and not for themselves?
I think most people don't care as much as me. So most people, if the compliance person says, just play it super conservative and don't do this, for the most part, they actually don't really care. But, a big part of my personality is I like to be able to say what I think. I value that actually even more than running a fund. So if push came to shove and the SEC is like, you have to stop saying what you think and we're going to be real strict, I just shut the fund down. I don't think almost anyone else would do that. So I think that difference in attitude is big. And for the people who don't care as much as me, just maybe you suck it up and you do pay the consultants 100 grand a year, and then you're probably fine. You don't even have to think about this all. But I don't think it's a smart road to go down. I think it's always good to be differentiated in your business, and you'll stand out that way. And you know, my opinion is just being able to say things is the same thing as being able to think things, because that's sort of how you gather feedback. Um, so when you sort of shut out large parts of what you're even allowed to say, or if you have to like put everything you say through a filter, you can't even have like a proper conversation anymore. And I think that, yeah, I'd weigh that really seriously. And if you take that seriously, you should try to understand the law yourself, where you can push back. I don't think you're going to find a compliance professional who's even going to do this for you unless you find a real missionary who believes in your business. You're basically going to have to do this yourself. That's what I think.
Well, David, we'll leave it right there. Thank you so much for joining us today.
Yep. Thanks for having me.
As a reminder, this episode of Other People's Money is brought to you by SMH and SMHX by VanEck, two complementary or standalone semiconductor ETFs giving investors targeted access to the full spectrum of AI's growth engine, from manufacturing muscle to design dominance. Go to vaneck.com/SMH Max and SMHX Max to learn more.